final week of everything, except for it is the, I guess, a mini vacation week, right, with Thanksgiving on Thursday. So I wanted to say welcome, welcome, welcome. So before we really begin, let's double check, make sure that the sound quality is good. I know many of you, I thought I was going to be able to broadcast, sneak into the room, but it was very unlikely on this trip. I sent a couple tweets, and in hindsight, I wish I didn't use my iPhone, and I am, as I was long some IWM, I was long a few other positions, and on that rally, I couldn't help but to get out and sent the tweets out. Imagine my dismay watching IWM rally another almost 1.5%, 2% from my scale out. So where did I see resistance? Where did I see resistance? Well, first and foremost, we were coming up to just a little beyond in the Russell. And I'm not sure we're going to quite see it right now, but on the other platform, on the TradeStation platform, just as a quick indication, we are up against, if you look at, this was the quarterly, I mean, this is amazing stuff, but that's why after the elections we were bullish. We had, and I pointed out to you guys, and unfortunately I didn't put it in the weekly thoughts and observation, but it was a TradeStation Thursday morning briefing. We discussed it in this trading room Wednesday, the day after the election. At the time, the volume and breadth looked, according to the way I see things, was in the Russell a lot stronger relative to the other markets. I mean, we were starting to break out of old levels, and there was strong volume when we were at that junction. So for me, looking at the market, and then in addition, you love this pattern in it. This is kind of like my famous, which we did a few amazing seminars. They were awesome. They were stellar. I mean, these people, folks, they are so used to the same old thing. And I got to share this quick story, and I'll get right back to this. When I asked a group of, and I mean, some of these are wealth managers. They were not just individual traders. These guys have been through the ringer. They've seen people come and go, and they've seen the emails, and they were very, I would have to say, and at least this applies. This is being recorded, so they will be taking a look at this. So the guys in Germany, at the very beginning, because we addressed this, were a little apprehensive, let's say, of what I was going to be teaching. So the long and the short of it is, apprehensive is a polite way of saying they thought I was probably one of these telemarketer guys. Some of them had never heard of me before. Now, some had, and were excited to have me there. I was warmly received. After giving a little bit about my background, some of them felt a little bit more comfortable. By about 15 minutes into the presentation, I said, one of the things we're going to cover is volume. How many people use volume? And quite frankly, even though the majority of these traders spoke English, I thought they didn't understand me. So I stated it again. How many people use volume? And nobody raised their hands. And I was perplexed. And I'm like, are you trading this product called CFDs? Or nope. Are you trading Forex? A few people raised their hands. I said, okay, I understand you guys. Well, how about stocks? And everyone raised their hands. Everyone's trading stocks, the DAX and the stock market. And I said, you're not using volume? And I said, well, let me ask it a different way. How many people used to use volume and have found it doesn't work anymore? And I swear to you, a third of the room raised their hands. The other third wasn't sure they knew what volume was, which was kind of scary. And it's the same story and the same type of scenario that's been addressed in my presentations and books for half a decade or more now, right? Since like 2008. And I said, well, there's a little tool that can help you with this, and we'll go over that. And it's the same problem where you look at a volume trade, and we'll bring this home about how it relates to today's activities. But we gave him an example in the Russell, and we said there's some tools that you can use. It's kind of like looking at a screwdriver. You have a flathead, you have a Phillips, you have stars, you got hexagons, you got big ones and little ones. If you don't have the right screwdriver If you have a broken, your eyeglasses break and you need the little screw, and someone you say, I need a screwdriver. You need the right screwdriver to fix the right problem. And I said, that's your issue. You need the right tool to fix the right problem. Nowadays, many of the Europeans, and I want to also point this out to you, they're trading their markets, which are high beta with the DAX, for example, and the CAC 40. And a lot of folks, by the way, are trading E-mini S&Ps, and they are trading futures, corn, wheat, things of that nature. So the Europeans are more commodity-based is what I found. They're getting off of this Forex. They've just been not seeing great success trading Forex, and they're going back to trading commodities. But one of the things, the common denominator I want to share with everyone in today's thoughts and observations planning and scanning video is that the common denominator is the volume histogram has not been working. And I said, well, let's take a look at this. Let's see, as the market, even for ourselves, we were looking at that little downdraft. The breadth of the market goes down, the volume went down, and there's like volume went down. So it trended, and it just showed that this little decline wasn't going to be substantial. And then we got that right before the election break, thank God, right? And then what does this stuff do for you guys? And they said nothing. We don't know. It's not been working. I mean, the market rallies. It has light volume, but the trend and in over 1, 2, 3, 4, 5, 6 days, you miss a big move because you don't think there's any volume behind it, right? So, I mean, if you line things up like I did, there's no volume. And yet, here the market rallies substantially, light volume rallies. And I said, we have a solution, and they were very thrilled that I came up with that. And so with the same said, I said, and I didn't go over this because it wasn't part of our curriculum, let's call it, right? But pivots, right, as we would identify, if we close over the pivot and we close over a last conditional change, we generally see follow through. And that's kind of a nice day trade when you look at the relationship depending on the time period that you're using and versus the pivot point that you're using. And that's a bad arrow. So what I have here are quarterly pivots using a daily chart. And you know, we came right down to quarterly support. And then as we bounced off of this story with the Russell, we had good accumulation and volume. So now, with that said, we had identified this trade to the upside in this trading room, and we did it even with Thursday, a week ago Thursday, on TradeStation Thursday. I said the Russell and even retail, the XRT, should see a bounce. And quite frankly, that was the Thursday the 10th. So this is the 9th. You and I were in that room together, and we were looking at the strengthening. And then that morning, I said it is still a viable move in the Russell. We want to focus in on the Russell. So then we saw follow through on Friday, gap higher on Monday, get out of half. Then, of course, by Tuesday, it was like, you know, I thought as the market was nearing, the point that I was making is that we were near a quarterly R1. So the market had gone through a quarterly R1, and at the time we started to see a flattening of the volume action here on the daily basis. And on the weekly basis, I was getting a little nervous that this weekly was going up on lighter volume. So with that said, I thought, you know, take advantage, tighten stops, and it would make sense. And so that was the reason I sent those tweets, folks. So now I have to ask myself, is this a new leg to the upside? Meaning, is this market going to match the direction from this base? So is this a new leg higher? And if this is a correct, a trend that took place over 1, 2, and let's call it 3 years, then we did see the consolidation, and we did see a pullback in the small cap as we played that trading range. I mean, that's a, no offense, that's a heck of a price appreciation. So if the market is going to be in what we call a new leg to the upside, all right, so we'll not look at absolute high, I'll look at relative high. This relative high, my definition of relative high is that high lasted a very long time, it made a sequential secondary higher high, but then failed, right? So the average of the highs are right at that doji right there. So that's to me, that's the defining true high. And so if I take a look at this and I mirror that range move, all right, so from low to high, mirroring from that swing low to that absolute swing high, okay? Let me get it here for you. The question now begs, more or less, and I'll try to line this up if I can. You know where I'm going. If I just take the measuring stick, kind of speak, you get an idea. This would be, if this is an, I guess in Fibonacci, we could use a Fibonacci tool, but I prefer to just do it quickly like this. I mean, how much more upside, if this is a trend consolidation and in a resumption of the trend, if this is a new leg to the upside, how much higher can we expect the market to go in the next few years? And it's about a 32% upside target. As long as the dynamics of the uptrend continue, as long as the dynamics of the market conditions, keyword, meaning as the trend matures, then and volume analysis trends and we stay above those moving averages, okay, and on a longer term, then the absolute answer is yes. But it doesn't mean that throughout history of this first trend higher, and I've got to tell you, I think the market is in a growth story, and I think the elections and a Republican win and getting rid of modifying, I didn't say get rid of, I didn't mean get rid of, I did say it, I modified Dodd-Frank, a moderate pullback on some of the regulatory restrictions, allow fiscal policy to work. After all, Ben Bernanke said there's not much the Fed can do in lowering rates. They're at zero. We need fiscal policy changes. We need non-protectionism. We need allowing the world to work, to move. And so I think the globalization camp that thought that there would be prosperity built for everyone if we had knockdown barriers such as the Eurozone. And everyone thought that this would be great for the world. And it is on average, right? I mean, if you look at some of the emerging markets in foreign countries, they've improved. Vietnam, for example, a lot of emerging markets have seen prosperity improve, right? Mexico, Central America, Latin America has certainly seen improvements where they have been in the last 10, 15 years. Czech Republic, Eastern Bloc countries, which used to be Soviet, which are now, you know, albeit apart from Ukraine, of course, but we've seen an improvement, or kind of like a rising tide, but it's stalled. And I think what we need to see is improving fiscal policies. And so that's the difference in and that's what many people are kind of scared about and I'm just giving you a more political view of policy, not candidates, okay? So in the last 8 years was more about global growth and globalization, and right now with a newfound person, it's like, guess what, guys? We're more concerned about America rather than seeing our trade partners in Chile and Argentina and China do better. We want to do better here, and that might be why we get this small cap growth, domestic product, more which is relating towards the regional banks with the Dodd-Frank change, pharmaceuticals, perhaps now we don't have to worry as much with things of that nature. And maybe there's still more chance for energy, small cap energy stocks to go up, and that's why I think longer term we might see a really strong move to the upside. This is a monthly chart though, and this is a 3-bar reversal swing high. And guys, at the end of the month, if we close above that level, if this was a 5-minute chart, right, you and I would both be looking at buying the next pullback. You got, I mean, maybe scale in some just to have some lightly, and we would be praying for a pullback. If this was a 5-minute chart and this was a trend, a consolidation, and if pivot resistance was up there and pivot support was down here, guys, we would be looking at buying this on a 5-minute relative basis. But this is a monthly chart. And so I think the pattern speaks of itself and the condition of the market. So if I'm long-term bullish on this market, right, and I think at least how do we trade it? And I wanted to point out I am still, as we are past R1, and this is the quarterly pivot resistance, okay? I think maybe I was a little, I don't know if we're going to get quite up there right now. We could, and it would be my bad for leaving profits on the table. But I don't think right this minute is time to initiate a short position in the Russell quite yet. We don't have enough evidence of a reversal. I am looking for a correction because from current prices, and I want to share this with you, look where we are, current prices, and the higher this thing goes, guys, the higher this thing goes, which we're near resistance, the higher it goes with the moving average and the pivot down here, there's a huge gaping space. The next time period, which is what? Next month, because this is a monthly chart. Every time we've kind of gotten a little too far ahead of where the moving averages are and we get into a breakout mode, we tend to get a pause and allow the market, and this was 1, 2, 3 months of pause, by the way, after a breakout, where the market really didn't do a lot and it just allowed time for the moving averages to catch up to price. And I just wanted to share with you, that's what I wrote about this week. While I believe that because we are further apart from the pivot points and the current price and the moving average, we've departed a little too far from the means. It doesn't mean it can't go up a little bit more, and I'm counting on it to go up a little bit more. And then I think you have an excellent opportunity for maybe some credit call spread opportunity, writing some out-of-the-money calls, and I think maybe the January, we'll look at in the next couple days, we will take advantage of what we do find this week as a phenomenon of traditional holiday strength. Typically, we do rally the day before Thanksgiving, the day after Thanksgiving, and lately, as we get reports over the weekend on consumer shopping, how much spending went on and who was the winner. Was it Walmart? Was it Target? Was it Ross Stores? Who put on the best deal? Who put on, was it Best Buy? I mean, who is going to win the consumer retail dollar, right? And so all of that does matter. And if it's been kind of overpriced in the market, it's kind of like buy the rumor and then maybe sell the fact, or at least look for a pause. So I'm not sure I'm looking for a short position as much as I'm looking for a consolidation type strategy as we near, and then keep in mind, we're trading, let's face it, 131. And we have quarterly pivot resistance at 134. And a lot of times we've come close to the quarterly pivot, hit the quarterly pivot, exceeded quarterly pivot, didn't come close to it, didn't come close to it, didn't come close to it, exceeded it, didn't come close to it. And it's been quarterly pivots, at least with the Russell, in the last 6 years, has been pretty dynamic, by the way, not in the basis of actually calling the highs and the lows, but also the trend direction. So out of all the indices, the quarterly pivot is the one that I really trust more than anything is in the Russell. And as we near that resistance, the further we go from here and higher, and the closer we get to that quarterly resistance, I believe putting on at least a theta time collecting out of the money call strategy is in order for this particular market. Now, this is a monthly chart. I'm going to go back to a weekly chart, and I want you to, when I posted about the separation, I was talking about, at least with Genesis. Now, I use Genesis in this trading room because Thinkorswim, we have not added it yet. It's coming, I think, in 2017, the gold line. I constantly tell this story about why we don't have the gold line. The gold line was not added because someone thought that it would confuse people and therefore did not want it to add. But they loved the fact that the person's pivot accurately told of higher highs and lower lows and that type of combination to give you an overall trend direction of the market. And then when the trend reversed, they liked how the pivot analysis gave, with the person's filtering system, a targeted high pointing out higher highs and higher lows, as it did last quarter very successfully. So now that we're up here, what I wanted to share with you is looking at this chart. First and foremost, we still have quarterly pivots, but a weekly chart. Here's the pivot blue, and here's the 3/4 moving average of that blue way down here. That is a massive separation. And, you know, typically when you look at a separation between the average over time, when it gets to a certain standard deviation, testifiably, not that you could look at a chart and say, gee, it went from here to there in no time, it's overbought, but I can also look at this statistically and say, gee, when the market gets too far away from that level, okay, the market, when it's close, you know, like bearish, it may go down. When it's close, it's still bearish. It's still bearish. But when it changes blue over gold, as it did, and then separates that far, it gives us the idea that the market is in an overbought condition. And so looking at the monthly, the blue gold on a monthly basis relative was, you know, just acting in accordance to the last 3 months. But look at the difference on a weekly chart. So for that, I need to change the time frames, and I'm going to go and use a 240-minute, and then I'm going to use the weekly. And so when you look at the, and then let me go over here, and just this is probably too much of a trading lesson, but it gives you a better idea how I interpret the pivot analysis, just like with using a moving average approach. When the short-term moving average departs too far away from the long-term moving average, and price really exceeds and accelerates beyond both moving averages, either one of two things happen. Either the moving average, the market pauses, allowing for moving averages to catch up to price, or price comes back down. It's called regression to the means, a term I never invented, but a principle that I use in my analysis. So let me go here in the date axis. Maximum days 25. Well, we want to use maybe 90. We'll go to 90. Yes, it's a lot of data. I want more data. So look at the combination here. Look at the separation between blue and gold, blue and gold, blue and gold. I mean, the weekly pivots really did help define, you know, condition and trend of the market. I mean, blue below gold, blue below gold. But look at the separation between the blue and gold relationship, all right? So this is the election things changed, and at the end of that week, we went from blue gold. Look at that separation. It's still bullish. The market did go up. And look at where we are right now. There's the blue and there's the gold. We have a tremendous separation, and that's what I'm talking about for this week. So if we go up any further, and I'm saying like maybe 131 up to 130, any further from 131, we go up to like 132, 133, 134 max. Look at what we have. We have an old quarter. We have weekly pivots. We've got some reasonable expectations of a targeted resistance zone up here, right? And anything above that level, I believe we will see a pause in the market's advance. So that's what I was defining, and I'm going to leave that red there. That's really what I was defining for this particular week. And I think that for an option strategist, this would be good. And for day traders, we want to focus in on the 60-minute volume, number one, and look for divergence if we get higher highs in the price this week. So let's review the week. We've got Monday. We've got Tuesday. We got Wednesday, kind of a weird day, right? Because everyone wants to get the hell out of Dodge. And then we got Thursday, which we're off, but Europe's not. So Thursday's a really weird day because of the sense that, you know, British citizens don't really celebrate the whole Thanksgiving thing. You know, it's not their thing. It's our thing getting away from the British, right? The English, that is. And so Thursday's going to be a holiday, but the currencies are open, foreign markets are open, so it's kind of a weird day. And then on Friday, we come in with Black Friday starting Thursday. I don't know, Black Friday probably already started. I don't know. I've been in Europe, so Black Friday, the big holiday of shopping, probably started a week, probably at Halloween. I don't know. But I do know that everyone's advertising that they're open on Thursday, Thanksgiving. So I'm not sure that's a big thing. But more importantly, Friday's kind of like a half day, right? Because then they got football, and it's time to spend with the family. And then we got the cyber, we got Saturday, we got Sunday. and then you got Monday's report. So I'm thinking if we go up here, we linger, we maintain the value slightly higher, and that's what I wrote about by week's end. So maybe Wednesday it really accelerates into the close. You want to pay attention to the closes. You do not want to sit here around 12 noon because funny things happen onto the closes. And watch your brokerage firm for details on the specific close on Friday. All right. Typically we close, I think it is a half a day. So I want to make sure everyone knows that. But the Globex is kind of open, and it's like I said, it's a weird holiday, and I think the Globex is still open on Thanksgiving Day. So we got to kind of beware and watch that. I've been traveling, so obviously I will get on to knowing that myself, believe it or not, when we get to it. So that's kind of why I'm looking at the market and where and the timing element about this whole correction phase of the market. All right, so I wanted to give that as a strategy. Before I left, I gave the trading community and I gave our traders 2 trade ideas. One, Apple. I thought Apple would stay above 105 and below 115. I recommended the iron condor, the 115, 120, and the 105, 100 iron condors. And Apple is, it didn't crash at 105. It didn't participate in the rally. It was up around 110 the other day. So, the problem with iron condors is you want the market to stay stuck in a range. And so when it gets to the lower end of the range, you're thinking, oh, God, you're worried about the market making newer lows, and you're worried about the put side of the condor. And then when the market rallies, then you're sitting here going like, oh, but if you don't get enough time premium decay, you can't trade around the position, meaning with iron condors, if the market goes down, if I'm in a call spread here and a credit call spread, a credit, or let's call it a bear call spread, a credit call spread, and a credit put spread, okay? So I want the market to stay between these 2 levels over time. So if the market comes down near this level in a very short period of time, you still have time on the upper side of the trade. You need time for the market to not do anything. And then if you do get time and it comes down, theta will take valuation away from your credit call spread, and you simply just close that side of the trade out. The market goes back up, and then all of a sudden, now you don't have to worry about this side of the spread. Now you can just look as theta comes by, and you could look at just covering that instead of taking and holding the position till expiration. Anyway, that was the idea that we went together in this room. I wanted to make mention of that as well, the different ways of trading that, and we'll re-examine that position as it is still profitable at this point in time. The next one that we went over before I left everyone with the weekly, and I said this before I left, you have a potential for a weekly high close doji in Chipotle Mexican Grill. We had that idea on Thursday if the market closed above the highs of the prior week by Friday. And guess what? It was kind of a fun trade because everyone knows the market did go up. And then imagine my surprise with CMG when here I am and I look at the market and we're trading, almost immediately up to 418. So, it was about a $20 move and in a very short order, a little bit more. And then the market pulled back for Tuesday, Wednesday, Thursday, and then, by the end of the week, the market went back up over 410. So either way, the weekly high close doji did work, and it was effective, and I hope everyone made a little bit of money on that trade because it was the right directional call in a really weird world. So where do we go from here with other markets now that the opening bell is here? I think that we get a little further upside in the market, okay? But as I was writing about, a lot of people, by the way, were talking about this, and I gave an analysis on breadth. Many people were using it, but they hadn't, in just switching over here, they did not know what makes indexes tick. Someone had asked me, part of the curriculum was talking about the McClellan oscillator and things of that nature and the AD lines. And I said, listen, guys, you got the DAX. We got 6 stock indexes. Maybe you're trading the CAC 40. Maybe you're trading the FTSE 100. Maybe you're trading different markets. But here in America, we've got 6 ways to 6 different flavors of bread to trade, all right, as far as stock indices. We've got the Qs, we got the Russell, we got the Diamonds, we got the SPOs. And most of the people were actually familiar in trading that. They go, but for these stock indexes, what do we do for breadth? We want to learn more about breadth. And I said, listen, the NYSE, the New York Stock Exchange Composite Index, it's mainly comprised over 60% of interest rate sensitive stocks. And so possibly that might be one of the reasons why the small cap looked better relative to the NYSE. So the small cap breaking out, and as you can see from the old high here, the this is not broken out yet. And while I do think there's a very strong potential, this could have been a head and shoulders. It broke out, it came back, it tested the neckline, and it is going up. We got to make sure this thing has strength. The breadth breaks out with the move, and there's decent volume with it, because if we get out of this peak high in the NYSE, then guess what? This is an inverted head and shoulders bottom, and this is, guy, by the way, I'm just pointing out to you longer term, this could be a new leg to the upside and a super bull market. I'm just saying, here's the trend. This is consolidation. And man, if we go from this trend to that peak and it takes the same type of measurement over the same period of time, then guys, we want to be on a lookout for further breakout. Now, I think we're a little stretched. We could see sector rotation, and that's what's been happening. We go from transportation stocks, biotech, we come out, we go in, we go out. But I do think that for the very short term, and I think this week I spelt it out pretty quickly, we've got strengthening markets for this week traditionally, and then we have a Federal Reserve that could put a little ice on the, put a little water on the fire and temper people's upside, but that's not for about, what, 3 weeks or so, right? So a rally this week into the end of this week and into mid next week, man, that's where I think you start looking for pullbacks, and or maybe if it continues to go a little too far too fast, then we take a look at some selling opportunities. But I wanted to make sure that you were crystal clear about the selling opportunities. The small cap, I think we might get a situation where we get small cap upside. We're almost, look where we're at right now. Further gains to the upside, 130, 173. We're getting close to that resistance target up there. And I think maybe people will say, you know what, I think it's gone a little too far. I can't stand it. I'm going to get out of here. And maybe we see some money going to work in here with the financial weight, or maybe we get a little bit of money to work and people feel compelled to buy into technology, right? So maybe it's just this was the leader, this is the laggard, and that's the laggard. So we want to watch for sector rotation and shifts of different markets. And maybe if we get an insight of movement with the breadth of the market and an uptick in volume, this could be meaningful. On a daily chart in the NASDAQ, on the Qs that is, a daily chart. So let's watch this real quick. A daily breakout above this last conditional change and swing high. That high right there was the high posted on November 20, this high is from November 10th, okay? This last conditional change, this volume and this breadth combination does not give me a warm and fuzzy feeling, meaning the market's trying to rally and there's no volume behind it right now. And we're starting to get a little overbought. So this area might act as resistance from a last conditional change perspective. But if we clear that level, that 119, and I don't know when it's going to be, maybe it's after a little pullback, I don't know. But we want to watch for daily closes over there on a new breakout with an uptick in volume, a breakout in breadth and an uptick in volume. That shows that there is momentum. It also shows that we're probably clearing what I am identifying as a potential trading range. For some reason, biotech, heavy large cap biotech, and as well as large cap tech names have not participated in the rally. Google, Amazon, Microsoft, they got sold off, but maybe people feel compelled that, they got a little overzealous there, and there might be some idea of cash coming into the sidelines, and maybe we put it to work. So we might see a spread relationship between people selling the Russell a little bit and buying the Qs or the S&Ps. And I did make that as a kind of a bullet point that spread traders might be looking to capitalize on this valuation by selling small cap, buying large cap in the coming days. It's a big bullet point. I wanted to address it and make sure that you guys paid attention to it. Last but not least, for the week of trading, I think it's important to also go over one other thing. It's the U.S. dollar is scaring the dickens out of people. The media, by the way, in Europe, we're trying to be political, but when you go to Europe and you don't bring, and I had Netflix, and yeah, I get that, but more importantly, gang, let me just point out something to you. The media, the BBC News, and any English station with the comedians were just absolutely, I mean, it is brutal. It is uncensored, and I mean, oh my God, it was just brutal. I don't care if you don't like Donald Trump, then if you hate Donald Trump, you would even have felt sorry for him listening to these news stations and comedy shows, right? They were just absolutely brutal. I mean, just absolutely no human being deserves that type of abuse. I mean, they didn't do it to, I mean, it was brutal. That's all I have no other words for it. I was dumbfounded. And all I can point out to you is they were more involved in that than they were about international finance and the exchange rate with the U.S. dollar. And then finally, people started to realize that the dollar is so strong, we're almost at parity with the euro currency, by the way, which was wonderful for us being in France and Germany when we said €5 for €5 for a Coca-Cola, no problem. 3 years ago when we were at $1.30, or 8 years ago when it was $1.50, I was like, oh my God, man, €5 for a Coca-Cola, and it has different meanings. So bottom line is, I think we are coming into a option expiration on the euro is one that actually, for whatever reason, I want you to take a look at this together with me. Option expiration, 1, 2, 3, 4, 5, 6, now 7. 7 option expirations. The person's pivots have been just dynamically interacting. So which pivots work best? And just the same thing that I wanted to point out to you. Where's the blue-gold relationship? It's kind of separated. The pivot's all the way down here. This is the lowest level the euro currency's been since. This is a yearly chart. That's the, let me go to a quarterly chart. Might give you a better idea. So where the euro currency is literally at the lowest level since we've seen since 2002. Oh my goodness. Now, typically I would say, hey guys, moving average crossovers offer a very strong support zone, and that would be true. And eventually, I think we go down there. But as you can clearly see in the market right now, we are trying to break this. This is a quarterly chart. This chart won't be over until the end of the quarter. But I can tell you this. Work with me just to humor me just a tad. All right? We're starting to see the commercials. What's the trend of the commercials? It's going up. And they're starting to build. They're not totally in a huge hedged position, which means there might be, as they go up, typically the markets sometimes rally. So when they reduce their hedges and the direction of the red line goes up, so therefore does the currency, right? It's a little bit of on a over time. So these guys are not looking to hedge for 1 hour to the next. They're putting on position and they're hedging. So when the direction of the trend of the red line goes up, coincidentally, so kind of does this, and the trend direction is starting to go up. And so I have to say, I think the commercials are building in a hedge, and we might see a little bit of short covering rally. The hedge funds and the general public, while yes, they are short, the public is not really short a lot. So it's kind of a neutral thing. But the hedge funds are on the other side of the commercials. Hedge funds get paid on a quarterly basis. They're really short right now, by the way. And if they do see any kind of profit taking between now and the end of the quarter, which is where they get paid, we might see a sharp short covering rally in the market. So as bearish as I want you to examine, and I understand that this market is breaking down, and I get it, and it looks ugly, and I got that. But you want to know something? It looked really ugly right there too. It made the lower closing low in the quarter. It was at the bottom of the range, and all I know is that the commercials started to get long the market, and it stopped and it reversed. Now it went down, but at that point in time, it wasn't going to continue down. Another thing that happened is you'll notice here real quickly as the market, and this will wrap up, as the market went down from that point, so did the volume. But what did we do? We made a volume low. We made a price low. And by the way, guys, we didn't make a new volume low. I just lost it. Sorry about that. You know, you can see what I'm kind of pointing out to. We did not make, as price made, a new low. We made an absolute area of lows. The volume action was not lower, so it was a little higher, and it had a little bit of convergence. And so I look at this and I go, we're at the base of a range. I've got public short. I got hedge fund short. It's the middle of the quarter. Eventually they're going to cover. I got a seasonally strong period of time in the market. I got open interest rising a little bit, and I've got no volume behind this decline. No volume behind this decline. Oops, no volume behind this decline. Oops. So to me, while it's not a guaranteed, I would say last year and right now, this might be the surprise trade to the upside. So I wrote this week. We have, and I pointed that out on a relative chart using weekly analysis. So let's take a look, and we'll wrap this up here, and I'll give you a full-blown explanation. So here's the weekly chart, and clearly, monthly, quarterly, we see a very similar picture. And I have to look at this and I have to objectively say, okay, I'm looking at this, I'm looking at that, and I see this, and I got to ask you guys, why isn't the volume all the way down here? The market has departed too far from the means, and it is susceptible for an upside rally. So we want to look at maybe FXE going into the end of the year. I gave traders in the weekly thoughts and observations several ways to look at it, right? Next support, was 105.41. There's a typo. It only shows, and I can't believe it, 1 point. It's missing the 1, so we'll figure that. It's 05.41. I hope everyone figured that out. 5.5. We're at 6.39. For gosh sakes, we're getting darn close to a little support. Okay, so look for a buy signal near that support. A, right? 105.5. Let's call it on the D's futures. Next, I would also look for, on a 60-minute basis, I would look for some kind of a pop in the market as we're kind of starting to maybe see, and might be a little bit already too late for this. We started to see this as I was giving this presentation over in Europe. You know, I said here we have a kind of an interesting situation. You know, the market's making relative newer lows, and we've got kind of like no new relative lows. So you might get a little pop to the upside. You and I would look at this chart and say not enough information, and you would be, you know, within your rights, absolutely. So here's our daily pivots, here's our weekly pivot, and so watch this. We absolutely have a swing high, a moving average cross, and if this market gets up above that swing high, and we get a pop in the volume, right, then I think we've got a quick short-term, sharp, short covering rally that's going to ensue. So that's why I put out there, watch for a sharp, short covering rally on a 60-minute close above 107.10. That's 107.09.5. So that was the weekly pivot. That's where that came from. Anyway, as far as new trades in stocks, gosh, I just really didn't have anything to really want to sell, but you know, hopefully maybe some pullbacks on some buying and some new fresh buy signals there in the stocks. Bristol Myers still, Hess, Juniper Networks. There were tons of sell signals that are already in the tank. Amgen, CA, Costco, Under Armour, Whirlpool. There's no way I'm taking those sell signals. They're like taking a sell signal at support after multiple weeks of declines. I'd look for upside move. Anyway, we also had a longer-term volume in Western Digital, and I hope everyone took the time to read that. And if it was a little too long this week, it was because I thought there was a lot to say and different observations and ways to trade the market. And I wish everyone a wonderful holiday this week. Thank you all very much, and it's great to be back in the States. Thank you all. That concludes this week's Planning and Scamming.